Hello everyone and welcome to our April Global FX Outlook for the month of April. My name's Stephen Dooley. I'm the currency strategist here at Convera and really excited to have you all here. It's been a really massive month in financial markets and FX in particular over the last month since we produced our last webinar in March. We're looking forward to covering everything that's happened over the last month and our forecasts and outlook for the next few months as well. We'll give it another minute or so. We'll let everyone jump onto the call and then we'll be able to kick off. Thank you. Okay, like I said, welcome to everyone to our Global FX Outlook for April, and it certainly has been a wild ride over the course of 2023 so far. You think about how we started the year, we were worried about the potential for a global recession, but as the data came in better than expected, we shifted from worries about a global recession to thinking instead the Federal Reserve might be able to pull off a soft landing. That view only lasted a couple of weeks before some red hot US inflation numbers saw markets believe that the Fed would have to raise rates up to 6% or higher. And then of course, at the start of March, the failure of Silicon Valley Bank, the forced takeover of Credit Suisse saw a focus instead on the potential for a full-blown banking crisis. So 4 big themes 3 months into the year. It's certainly no surprise if businesses, corporate treasurers and financial directors are feeling whiplash. It's been a uncertain and unsettling ride so far. We're going to cover all of those details and further. I'm really excited to say that apart from myself, who's the FX and macro strategist here at APAC, Stephen Dooley, we've got Boris from our European team who really focuses on the macroeconomic outlook, and Rob Goldberg, Director of Hedging from APAC. So really we'll be able to cover these big themes in financial markets. Boris will look at the global economic outlook. I'll look at the currency focus both in APAC and globally. And then Rob will look at some of the strategies that businesses can use to help manage the risk out there in financial markets. Like I said, just as a bit of a place setup, the big drivers that we've seen over the last month or so has been that stronger US dollar quickly reversed course over March, as that concerns about the US banking sector saw expectations for the Federal Reserve fall really sharply. We fell from the 2-year yield, which is the benchmark in terms of Federal Reserve expectations. It fell from 5.08 down to 3.6 in just 2 weeks. So some of the biggest moves we've seen in fixed income since the global financial crisis, and Boris will cover that in more detail. The euro was one of the big beneficiaries because while the market believed the US Fed might stop hiking rates, the European Central Bank is expected to continue to lift its benchmark rate. So that's provided real support to the euro. In Australia, of course, we saw the Aussie euro fall to 12-month lows. Similar in the UK, where the British pound has been stronger. Again, another candidate that might see further interest rate hikes. And in Australia, the focus was on the sell-off that we saw as a result of that banking crisis, most notably in the Australian dollar versus the Japanese yen pair. Now, the Aussie yen tends to be one of the most sensitive currencies to global economic outlook, and that big sharp fall that we saw in the Aussie yen was a sign that markets had become a lot more nervous. I'll come back and talk about currencies in a little bit, but now I'm going to pass over to Boris, and he's going to look at some of the big macroeconomic themes that have driven financial markets over the last month or so. Boris, over to you.
Well, thank you, Stephen, for the lovely introduction and a warm welcome to everyone joining today's webinar as well from my side. So my whole objective for the next 10 to maybe 15 minutes is to basically lay out some of the key macroeconomic themes that have been driving financial markets in recent weeks, and to also lay the foundation for better understanding the FX side of things that Stephen and Robert will be presenting afterwards. Because even though currencies are at their core driven by these divergences between, let's say, monetary policy, politics, and the economic development of their respective regions, there are some big picture macro trends that influence FX markets regardless of these regional specificities. And what I would like to do in this specific section is to just look briefly at one of these trends that has shaped financial markets the most in March, namely, as Stephen mentioned, the banking crisis in the US, and especially the response that followed by the Federal Reserve. So turning already to our first slide here, to better understand this full scope of the situation and to give an outlook for the next 3 to 6 months, I've prepared 3 charts that show us the topic from 3 different angles. One's from the commercial bank's perspective on the left, from the Fed's perspective in the middle, and then from the side of the real economy on the right side. The US banking turmoil at its core has been about 3 specific things in our opinion. Risk mismanagement at individual banks, unrealized bond losses during 2022, and smaller regional banks not being able to compete with interest rates at larger banks and especially money market funds. And focusing in on our first chart on the left-hand side, we can see that deposit growth at US banks had already started turning negative at the middle of last year. Normally, banks would start selling some assets like government bonds to make sure to cover the withdrawal of these deposits. However, given that especially government bonds, had just recorded the worst year since the 1970s in the US, banks had been sitting on unrealized bond losses worth around 600 billion US dollars. So by selling these bonds, they would have to actually book and therefore realize these losses, which some of them didn't do or couldn't even do. And in the case of the collapsed Silicon Valley and Signature banks in the US, most of this bond exposure was not hedged, which made the situation, of course, much worse. And this is why banks started borrowing. This is something we can see again in the first chart in blue. Borrowing by US institutions, so small and large banks in the US, increased to 918 billion US dollars year on year, with the third week of March, which was kind of the peak of this banking turmoil, seeing borrowing costs jump by more than 500 billion, which was the fastest weekly pace on record going back 50 years. And seeing deposits falling and borrowing rising in the first chart at the highest rate on record made the US central bank step in to ease this liquidity stress in the banking system. And this has been done by 2 specific steps. So firstly, with the introduction of a new emergency facility tool, or which the Fed has called Bank Term Funding Program, which basically lets banks borrow by putting up the government bonds at par, meaning at the initial instead of the current value of the bond. And second, by expanding the conditions of its deposit window. And the take-up of these lending facilities, which we can see in the middle chart, has been above $150 billion 3 weeks in a row, meaning that the Fed support has been appreciated and actually used by by these commercial banks. This has, however, as we can see here in red, also led once again to an expansion of the Fed's balance sheet that has been shrinking pretty much since the beginning of last year. And it has raised the quite significant question of if there has been created a trade-off between securing price stability on one hand and financial stability on the other, because one of these would need rate hikes, continued rate hikes, and a tightening in the balance sheet, and the other would need rate cuts and the easing in the Fed's balance sheet. But still, for now, the Fed's emergency facilities appear to have worked, right? While deposits continue to fall and borrowing continued to rise last week, the pace is significantly slowed. And this is suggesting to us that some pressures have actually eased with the introduction of these emergency lending facilities by the Fed. But this is something that we will be watching going into April, as the Fed is publishing balance sheet data and borrowing data every Thursday and deposit data every Friday. So this is definitely something to watch every week going into April. Another implication that we are watching very carefully is highlighted in our last chart here, because even though the short-term crisis has been contained, or at least perceived to be idiosyncratic instead of systematic, it is a reason why, for example, equities have rallied in recent weeks, right? And why bonds have started rising again. But the increase of the usage of the Fed's discount window, and this is something we can again see on the right-hand chart, the usage of the Fed's discount window does point to banks tightening lending conditions in the future, especially on consumer and small business loans. And this is one of the most important questions investors are trying to answer at this stage. Will lending standards tighten? And if so, will they actually substitute for the now priced out Fed hikes? Because if banks don't tighten conditions and inflation continues to surprise to the upside, why should the Fed pause its tightening cycle like markets are expected it to be? And this is something we touch upon on the next slide, because it's precisely this uncertainty about the medium-term implication of the banking turmoil on the economy, but also on monetary policy, why fixed income volatility had risen to multi-decade highs in March. Granted, as I said previously, some of the stress has definitely come off in the last couple of weeks just because of the coordinated measures by governments and the central bank. But focusing on the right-hand side text, we currently see and describe 3 reasons why volatility continues to be this elevated. First of all, volatility at pretty much the end and the beginning of every policy cycle is elevated, given the uncertainty about not only the direction central banks are headed, but also at which pace. Secondly, something that is quite unique to the current hiking cycle globally is that there are opposing forces at play, which is increasing the difficulty of setting policy for central banks. We have, for example, falling headline inflation versus rising core inflation. We have falling goods versus rising services inflation. We have a recession in the manufacturing sector in most parts of the developed world versus quite a resilient labor market and still a strong consumer. We have rent and shelter costs rising versus falling energy prices. The former would always suggest rate cuts, while the latter would suggest a continuation of these rate hikes. And lastly, narratives on markets are changing quite fast, given the macroeconomic volatility and even the data dependence of these central banks, meaning that pretty much every data release of importance might turn the next rate decision in either direction. One thing that has changed permanently since the emergence of the banking crisis in the US has been markets pricing in the end of the tightening cycle for the Fed, and now even expecting 3 to 4 rate cuts by the Fed before the end of the year. In our focus chart right here, we can see the expected policy path of the ECB and the Fed going forward, meaning that if one of the lines is above 0, markets expect the policy rate in the Eurozone to rise more aggressively than in the US. And this is the highest divergence between the ECB and the Fed we have seen since the foundation of the Eurozone. So markets are really strongly betting on a policy change from the Fed based on the assumption that A, inflation will be stickier in other parts of the world versus the US, and B, that lending standards will tighten more in the US, and therefore dragging down economic activity more. And this is why upcoming data will be quite important to watch, and we can turn to the risk calendar on the next slide to show why this is the case. Because gauging how likely these 2 assumptions are, the Fed and the US versus the rest of the world, will tell us if market pricing is correct on the Fed and other central banks. We are missing rate decisions from the Fed, ECB, and Bank of England in April, of which all 3 have already raised interest rates at the last meeting. But the central bank decisions in Australia, New Zealand, Canada, and Japan will definitely set the tone for the big 3 rate decisions in May. In addition to these policy meetings, inflation and labor market, of course, continues to be carefully watched. Both data points will be published for the UK, Eurozone, US, and Australia. And given that markets are still quite undecided whether these central banks will continue to hike rates to fight inflation or pause the tightening cycle to benefit the global financial market, the data will help convince markets one way or the other, given that the conviction rate, because of the high volatility, is not really strong in markets right now. However, as I mentioned a few times during my presentation, we will be watching most carefully data on the global deposit and borrowing flows and any signs of lending conditions actually tightening. And this is something we watch in the next slide. As we have written in the first paragraph in the right-hand corner, inflation has pretty much been the sole driving force determining monetary policy for the last 12 months. This has now definitely changed. So going into April, central banks have become more aware of the negative impact of tighter monetary policy and have become more data dependent. And so while inflation and labor market, as I said, will be extremely important and will be watched, the real question for central banks will be, again, A, if banks tighten lending conditions, B, if the availability of loans, especially for small businesses and consumers, will continue to suffer, and C, if all these factors will impact the real economy in a negative way. If it does, central banks will not really have room to prolong the tightening cycle any further. But if banks do turn the corner, if we have already seen the peak of this pessimism in regards to the banking crisis, rate hikes for the May and even June meetings will start becoming the consensus again. In our opinion, it will still be difficult to make the case for rate hikes beyond June, no matter what happens on the banking crisis, because given the expected tightening of these lending conditions from the commercial banking perspective in the next couple of quarters, and especially given that leading indicators already suggest weaker growth for world trade and for the global economy. In the US, for example, something that is watched quite carefully is, of course, the labor market and the non-farm payrolls report coming up on Friday. And both the ISM Purchasing Manager and the NFIB Small Business Survey, so two of the most important surveys and leading indicators for the job report, suggest negative jobs growth starting around the end of Q2, beginning of Q3. As of now, granted, hard data has been quite resilient in the US, as Stephen has mentioned, and it has been quite resilient to these deteriorations of sentiment and survey-based leading indicators. And even if we start seeing some of this expected economic weakness, it's still up for debate if the weakening of headline inflation and economic data will be enough to convince central banks to cut rates again, especially given that core inflation rates still remain extremely elevated. So again, this is something we'll be watching primarily parallel to the interest rate decisions, labor market and inflation data. The question of how much the availability and the conditions of loans for small businesses will tighten is something every central bank will be watching going into April. So with this big picture in mind, I would like to hand over to Stephen, who will give us more of a closer insight into the recent development on the FX markets. Back to you, Stephen.
Thank you very much, Boris. Really appreciate your time there and really great insights as well. I'm going to cover now some of the core outlooks that we see across the APAC region, and then follow up on more of a global outlook in terms of the FX outlook. So what we do in our FX global outlook document that some of you might have seen is a couple of tools that we use, volatility analysis and our value indicator. And the volatility analysis tells us which markets have been seeing the most volatility and which markets have been seeing the least volatility. And I mentioned at the start that one of the best barometers in terms of risk sentiment tends to be the Australian dollar versus the Japanese yen. Now, it might sound like an unusual currency pair to talk about, but historically, because it's been a favoured carry trade where speculators will buy the Australian dollar versus the Japanese yen to gather a carry or a overnight interest payment, it tends to be very, very volatile and very sensitive to changes in risk sentiment. And you can see that over the last month or so, the fact that the Aussie yen was the market that saw the most volatility tells us that markets are more concerned at the moment. It's a real barometer in terms of risk sentiment. So really important to see that the Aussie yen last month has been one of the most volatile currency markets, and it's a sign that we might see more volatility as well. In other markets, it's notable that the Aussie pound and the Aussie euro also saw a lot of volatility. We harken back to that at the start, that while other major economies are starting to see fall in rate expectations, in Europe, in the Eurozone and in the UK, markets still believe that they will require rate hikes to try and control inflation, which remains much too high and hasn't really shown signs of turning apart from the most recent data points. So that's why we're seeing a lot of volatility out here at the moment in the Aussie euro and in the Aussie pound. Now, the Aussie US did see still quite a bit of volatility in financial markets, but what's notable is that that volatility did drop off a little bit from what we've seen historically, certainly over the last couple of months. That's because the US dollar didn't see quite as much volatility because of that big drop in the expectations for the Federal Reserve, as Boris mentioned, and then the smallest amount of volatility in the dollar Sing and the dollar CNY, the Chinese yuan, after the first couple of months being really focused on the Chinese reopening story. Instead, markets were really looking at the concerns about that banking crisis throughout Europe and the US. So China and Asia more broadly kind of fell off the radar last month. Which markets are looking the strongest compared to their average rates? And so you can see that we measure that the year-to-date average, the 1-year average, 3-year average, 2-year average, 5-year average. You can see that those markets where we're seeing the most strength, again, the US dollar versus those Asian currencies, the the US Chinese yuan and the US Sing dollar pair. So that's where we're continuing to see that more strength in the US dollar versus those key markets. Where we're seeing the biggest weakness, again, like we mentioned, some of the Aussie versus the European markets. You can see the Aussie euro well below its recent historical trading range, its recent historical year-to-date and 1-year average, and same with the Aussie yen, well below the year-to-date average and the 1-year average. So this is a heat map essentially that shows us which currency pairs are the strongest relative to their recent average and which currencies are the weakest relative to their recent averages. And clearly, Aussie yen and Aussie euro amongst the weakest, dollar CNY and dollar Sing dollar are the strongest relative to their recent trading averages. So let's have a look at some of the forecasts that we're looking at the moment, and we'll cover all the major currency pairs in the APAC region, then we'll look more globally. And again, the Aussie US, you can see that broadly the view is for a slow grind higher over the next 18 months from where we are currently up towards 68 to 69, but nothing too excessive. And the central scenario is that while inflation does slow, so does growth. And that's clearly the big risk. Boris mentioned this in his section, that so far, particularly in the US, the hard data has been strong, but we're waiting to see whether this starts to turn lower. And it's important to consider how many interest rate hikes we've seen in the US and globally in other key markets. Those massive string of interest rate hikes will start to have an impact on consumers, on businesses. And then, of course, as Boris mentioned as well, the impact of these bank stability issues will also impact on banks' willingness to lend. So that outlook means that the expectations for global growth, while not necessarily dire at the moment, certainly do suggest that growth is going to find a lower than we've seen recently baseline. And that's historically the kind of environment that is more negative for the Australian dollar. So that's why our view certainly is that any gains in the Aussie dollar will be muted over the forecast period, really because while inflation will slow, so will growth. What are the scenarios that can move that view around? Well, first of all, this Chinese reopening story is going to be critical. If this gains traction, then that can help the Aussie dollar higher as well. So far, we've seen a good start to the Chinese reopening story so far this year. But again, we're going to need to see more evidence over Q2 before we become more positive on that. So for now, as you can see, to sort of move above these low 70s that we see as our central scenario, the Chinese reopening story will need to benefit. Potentially, if the Federal Reserve starts to lower interest rates, that can help as well. What can drive the market lower? What can impact the Aussie dollar further lower? Well, that's if inflation remains sticky and the Fed inflation fight continues. That's one of the key risks for the Aussie dollar over the next 12 months, that if the Fed doesn't have the ability to stop raising rates, if it remains persistent beyond June in terms of inflation, then that's what can really knock the Aussie dollar lower as well. So again, you can see the baseline scenario. The Aussie US historically moves 19% per year. So we'd expect as our base scenario, the Aussie dollar over the remainder of this year to bounce between 65 and 71. That's about how far we've seen in the range so far this year. And that range, certainly the core looking forward, and those two scenarios are what can drive either the Aussie to the upside, a Chinese recovery, or to the downside if the Fed inflation fight continues. Let's cover a couple of other markets as well. And the Kiwi US is a market where we're broadly expecting to see a move back lower for around about 63, 64, now down towards 61 for the end of the year. And again, like we mentioned, the Aussie dollar, slow growth globally is going to weigh on the New Zealand dollar. If we can't see the kind of growth that we saw in 2021 or 2022, then the Kiwi is likely to underperform. Particularly important for the Kiwi over the next 48 hours will be that next decision from the Reserve Bank of New Zealand. Like the European Central Bank and like the Bank of England, the Reserve Bank of New Zealand is one of the few banks where markets still believe we're going to see further rate hikes. But on Wednesday, the 5th of April, when they do meet, if they indicate that they're nearing the end of a rate hiking cycle as well, then that can weigh on the Kiwi also. We think they're near to that, and as a result, that's why that view for the Kiwi can press back lower. What are the scenarios that can drive us outside of that central range between 58 and 65 over the next 12 months? Well, again, a Fed pause can certainly help the Kiwi, particularly if the Kiwi keeps raising rates to the downside. Similarly, like the Aussie dollar, if that Fed inflation fight continues. The dollar CNY in this market, it's been a market that hasn't seen quite the RMB strength that perhaps markets were expecting earlier in the year. We've been trading broadly between this 680 and 7 level on the dollar CNY for some time. But broadly, we do expect to see the US dollar CNY drift back lower. But as you can see, the difference between the March baseline forecast, which was considerably lower, we've now got a higher rate in terms of our forecast for the dollar CNY. That's two factors. First of all, the US dollar has been better supported throughout Asia as worries about the banking crisis cause markets to worry about the impact on regional growth. Second of all, like we mentioned earlier, the Chinese growth story hasn't materialized as much as some markets hoped. And most notably, you might remember at the start of March that we got a fairly underwhelming growth forecast from the from the Chinese government, which settled at around 5%, very ambiguous target. That's lower than the 5.5% they forecast in 2022, and it's well below where markets thought we might see as the Chinese economy reopens after those restrictions in 2022. So far that Chinese growth story hasn't eventuated. Some of the data we're going to be watching very closely is how much stimulus are we getting from the Chinese government, how much opportunity are banks having to lend, and it's going to be that expansion of credit that's going to be absolutely critical in terms of the Chinese economy. So far we haven't seen it, and the commentary from the Chinese government suggests that they're not necessarily that keen to drive excessive growth. Slow and steady wins the race from the Chinese government, but it doesn't help the RMB. Again, what's going to drive that further to the top side or the downside? It's going to come down to the Federal Reserve. Like Boris said, what can drive volatility in markets tends to be near the end of a tightening cycle, also at the start, but where we are now, we're a lot more focused on the end of the tightening cycle, and that's why the volatility seen here in the dollar CNY is really going to be driven by the Fed when they eventually pause. They keep hiking rates, that can push the dollar CNY back up to those highs around 7.20. If the Fed ends its hiking cycle and starts to cut, then that's when we can start to see the dollar CNY moving back below 670 down to 660, 650. So again, what's probably most interesting is that the range in the dollar CNY, you can see, is a lot broader now, and you can see here that the last 2 years really been defined by a lot more volatility in the dollar CNY after years and years in which that volatility was really compressed by the People's Bank of China. We're seeing more volatility in the dollar CNY, not like we might see in other developed markets, but certainly another sign that the Chinese government, the People's Bank of China, is trying to allow the CNY to trade more freely. Let's finish off in Asia with the dollar Sing. And again, this is another market that's seen its forecast lifted from our March baseline forecast, previously around 132, now up to 134. Similar story, Chinese growth hasn't fired as much as the market had hoped, and also concerns around the impact of the bank stability crisis on regional growth. One thing we haven't mentioned as well is that we have started to see a bit of a drop-off in manufacturing data globally, but in China as well. And that impacts the Singapore economy, because the Singapore economy is very focused on trade as one of the world's biggest ports. If people are moving around goods, then that has a big impact, boost the Singapore dollar. If they're not moving around goods, if they're focused more on services, well, typically you don't need to put a service through a port, and that means that the Singapore dollar won't be able to strengthen quite as much as the forecast had been originally. That's the outlook for the APAC region. Let's have a look at the global outlook. I will only touch on this for a couple of minutes. Remember, all of this information is available in our FX currency outlook document. Speak to your relationship manager or your contact at Convera if you want more information about that, or of course you can go to our website for a whole range of details and material. Looking at global volatility analysis, again, some of this volatility that we saw in bond markets. Boris mentioned that the volatility we've seen in bond markets has been unlike any time since the global financial crisis, in some measurements since 20 years. But that typically moves in bond yields do move emerging markets more than developed markets, and that's why some of the biggest moves we've seen globally have been in the US dollar versus emerging markets FX, particularly versus the Mexican peso. Other big moves again in the dollar yen, really seeing a lot of volatility. We talked about the yen as being sensitive to risk appetite. It's a safe haven, and importantly, over the last month, the Japanese yen has been seen as a safer safe haven than the other two big safe havens. The US dollar, of course, the center of these concerns with Silicon Valley Bank, and in the other major safe haven, the Swiss franc, of course, with concerns around Credit Suisse. So the two safe havens that historically benefit from markets when they are worried, the US dollar and the Swiss franc, not seen so safe in March due to those banking issues. To the downside, we already mentioned that the left volatile pairs, $CNY, again globally, even hangs on to that position. The focus really a lot less on growth, a lot more on financial stability, and again, that's why the dollar CAD, the Canadian dollar, also under pressure with less focus on global growth and that slow march lower in crude oil. For most of March, of course, apart from the last couple of days after that shock production cut that we saw from OPEC. All right, let's have a look at some of our forecasts here. And the euro US dollar, like we said earlier, that forecast here also drifted a little bit lower due mainly to global growth and bank stability issues, but still broadly seen as having the capacity to drive up higher. And the central scenario is really that the European Central Bank likely to continue to hike rates, certainly in the short term, while most other central banks consider that they might remain on hold. You can see what's really going to drive the moves in this market. Really waiting to see from the upside any kind of resolution to the Russian conflict. To the downside, the potential for a slowdown in European growth can drive the euro further to the downside. But regardless of those central scenarios, I think what's most interesting in this market is the volatility expected to see in the euro. The central scenario has a downside of 102, a top side at 116. That's around a 15% range expected over the last 18 months. So volatility expected as markets come to grips with the expectation for the European Central Bank, for the banking crisis, and of course that Russian conflict in Ukraine. Similar in the British pound, also broadly expected to hold steady around current levels. It's been trading in a really clear trading range between 118 and 124 for the last 6 months or so, and broadly that trading range likely to persist. But for now, you can see a broader trading range, just like in the euro US dollar, in a similar story to what we already mentioned. So volatility expected in the pound versus the UF, but overall seen as broadly steady around current levels with the potential for ongoing volatility. Okay, now, of course, remember that the Market Insights team here at Convera look at a whole range of currency forecasts. And what I've just presented to you about the APAC region and the major currencies, we can certainly provide to you about other more exotic pairs. So certainly just reach out if you have further questions about that. From now, I'd like to pass on to Robert Goldberg, who's our Director of Hedging from the APAC region. And this month, with the volatility that we've seen in financial markets, and not just the volatility, because some markets are seeing really wild swings like the bond market, but other markets like the share market have been less volatile. So it's not just the volatility that we want to cover, but it's more the uncertainty. I mentioned earlier how there have been sort of 3 or 4 different views in financial markets to start off the year. We started off thinking that there was going to be a recession by the end of January. Markets were hoping for a soft landing. By the middle of February, we were concerned that inflation was roaring back and the Fed might need to raise rates to 6.5%. And then, of course, the banking crisis hit us in early March. With such uncertainty, I wanted to pass on to Rob and ask a couple of key questions that we're really getting from our client base and our customers at the moment. And Rob, I guess the first question that we wanted to hear from you today was, following the banking crisis, what are your customers and our customers telling us or asking us about the most?
Thank you, Steve. Hope you all can hear me okay. Yeah, so it's an interesting market we're in right now. The question is asking about following the banking crisis, but the banking crisis is just one factor that we're seeing, make markets move as we've just discussed. So customers are telling us that they're seeing more uncertainty than ever. The banking crisis is one factor, but we've got central banks and the RBA and interest rates that we've just been talking about, inflation, post-COVID changes that we're all experiencing. So there are many factors causing the market to move. So the question we obviously hear a lot is, what should we be doing? Probably more specifically, the question I get asked is, which way is the market going? But regardless of which of those questions you're asking, we do see some customers that are sometimes at a bit of a loss or kind of lose their way a little bit in these turbulent markets. And the issue there is that it causes difficulty around planning within the business when you're not only finding it hard to sort of navigate FX markets, but also factors that make forecasting difficult. So FX takes up a lot of time and it can take up a lot of emotion. And so that's the kind of the message that we're hearing from customers right now. Yeah, they're trying to find ways to to navigate the current markets we're in.
Thank you, Rob. So I also wanted to ask, how should customers be rethinking managing risk in this environment?
Well, hopefully many of our customers are already managing risk well, but for those that could perhaps be rethinking it or maybe taking a different approach to it, I suppose probably my number one message would be that your business is probably not FX. So FX is a part of your business, it's a risk to your business, but it's not the main driver of your business. And we want FX to become something that is managed to allow you time to focus on your core business. So the number one way I would suggest rethinking managing risk right now is simply having a plan. Having a plan in place will help you navigate those ups and downs. And in hand with that plan, I would also say that you're not alone. Okay, if you're working with Convera, you've got an account manager, you've got a hedging specialist. We're there to work together and to help you achieve what you're setting out to achieve for your business. We want to think logically with you about what has worked in the past, what maybe could have worked better, and then work with you to sort of formulate that plan or refine your plan to help you try and achieve some of those goals. Also, we, if we are looking to rethink how we are going to sort of navigate that risk, have a good think about what are your goals, right? Your goals might be to achieve a budget rate. They might be to manage cash flow, provide certainty. Perhaps you have a market view. But what I would say is don't try to pick the highs and lows. Think about avoiding losses rather than targeting gains. And always start with the hedge. Think about the risk that you're trying to protect in your business. And then all the other goals that you're trying to achieve should follow on from there. How do you do that? Well, there are many ways you can do that. One of those ways is by looking at the products that you use when you hedge your risks. There are many different types of products, and each product will obviously work in a different way. And those products will hopefully give you an opportunity to achieve your goals, and a mixture of products can also be good. So exploring how those products work and working with your hedging advisor is a good way to start. One question I often get is, a customer might come to me and say they're trying to achieve a target rate, and they've missed their chance to achieve it. So thinking or rethinking rather your strategy, perhaps looking at different products that will provide certainty if the market continues to fall or go against you, but still give the opportunity to achieve your target rate if the market should recover. So it's always worth exploring the different products that we can look at in order to try and achieve your individual goals. The other thing I would just add as a last point is think about orders. orders are a great way to capture market moves if you haven't already included that in part of your FX management toolkit. Moves can be quite volatile, and sometimes we see them while we're all tucked up in bed. By having an order in place, we can capture those rates even if they're only there briefly.
Great, thank you, Rob. I've got one more question for you, but before I carry on, I'll just say to the audience, don't forget that you can ask questions in your GoToWebinar toolbar. So please, if you have any questions for either Rob, myself, or Boris, take advantage of that. We've got a couple coming through, but any other questions would be pleased to answer. All right, back to you, Rob. Just finally for today, what key steps should organisations consider to get ahead or stay in control?
Again, I think the answer is around having a plan, making sure you have a well thought through plan of attack so that you can navigate the markets regardless of what they do. If you don't have a plan already, it's never too late. It's always a good time to introduce stability to your FX exposures, and that's what we're here to help you do. One of the things that I like to talk about that should form part of that plan, and something that's often overlooked, is what I call your approach to hedge. That talks to things like how much to hedge, how often to hedge, how far out you might hedge, what are your competitors doing, what is your pricing cycle like, how easily can you change prices. All these things should also play a factor in how you approach your hedging plan. And when you get a good plan with a good product mix, you can have a really powerful hedging solution that will help you navigate all these uncertain markets. So I suppose sort of to wrap that up, I would say work with your corporate hedging manager or your Convera representative. We want to work together and continue to form close relationships so that we can get to know your business well and help you have a successful outcome.
That's great. Thank you very much for that, Rob. We'll move on to our Q&A, but just before we go, just wanted to focus on what we try and do for businesses, and what businesses that deal with us should be front of mind. And certainly, we've already discussed the currency volatility and the material 5 to 10% shifts that you can see in FX markets over a course of 1 or 2 weeks can have a significant impact on businesses. So talk to us to help managing that currency volatility. Geopolitics, which really remains front and centre. It's been the biggest driver of financial markets over the last 12 months, with that massive move higher in commodity markets after the Russian invasion of Ukraine, and the impact that that had on inflation and the impact on supply chain risks. So speak to us about how we can help with diversification. And again, to return to that Russian invasion of Ukraine, the impact on sanctions and the way that we've been able to help businesses work within that increasingly more complex environment. It's just another part of how we can help businesses above and beyond, and including, of course, the FX payments that we will help businesses with. But like I said, I wanted to move on to the question and answer. And the first question that I've got here is really for Boris. And again, it goes to that banking crisis, which was front of mind just 10 trading days ago, when there was concerns that the German giant Deutsche Bank might be facing liquidity issues, and it just seemed to completely be erased from markets over the last 10 trading days or so. So Boris, the question is, how do we know when and if the banking crisis is over? Is it over now, or what kind of signs should we be looking for to feel more comfortable that we might have got through the other side?
Yeah, thank you, Stephen. I appreciate the question. So as I mentioned earlier in my part of the webinar, the main focus has now shifted from these primary data points, which was inflation, labor market data, consumer data, to more looking at data in terms of the borrowing and the deposit flight in the US, right? And as I mentioned, we have these data points. They are quite limited, but the Federal Reserve is publishing its balance sheet summary and also the borrowing of US commercial banks every Thursday, and also the deposit on the data on deposit flight every Friday. So this is something we'll be watching. And basically our signal here, our cue on the end of the banking crisis is, first of all, if we see these outflows from smaller banks to larger banks and money markets funds stop, or at least decrease on a week-to-week basis, this would probably be something where we would say we are starting to feel more comfortable taking in more risk. But again, if we look at the flows of the last week, they definitely slowed. At the peak of this banking turmoil in the second and third week of March, we had, as I mentioned, the largest deposit flight ever recorded from small banks to larger banks and money market funds. This deposit flight has slowed, but we are still seeing flows going from these smaller banks at which investors are starting to feel less safe in terms of the deposits above the secured $250,000 mark, and they're switching or shifting this capital to more secure larger banks or even money market funds where they're getting around 4 to 4.5% interest compared to pretty much no interest at all on their checking account in smaller banks. So what has to happen, of course, is that the Fed and the FDIC have to ensure that investors are feeling safe at smaller banks. And the second thing that would normally happen is that in some way or another, there has to be a convergence between what investors are getting at their checking accounts and their investment accounts with smaller banks and what they're getting at the money market, because the divergence is quite large and there is no reason for any large investor to actually hold their cash in smaller banks, right? Because they're just getting no interest for it compared to getting 4 to 5% interest on the money market account. And this is why some economists and analysts have actually called for the Fed to decrease the interest rates to kind of manually close this gap between smaller banks and money market funds. But again, I feel like this is missing the bigger issue, because the problem, in my opinion, was more the safety factor instead of the interest rate factor. And this is why, again, these data points on a weekly basis on Thursday and Friday will probably be more market moving than any other data point that will be released in April.
Thank you very much, Boris. That was fantastic. The other question we have here, I think, is probably more for me, but it's really about why haven't we seen a big drop-off in the Australian economy despite the 10 interest rate hikes that we've seen from the Reserve Bank of Australia. It's been a really rapid move higher in Australian interest rates from close to 0 to 3.6. I mean, it's been a similar experience right throughout the world. And look, it's a great question, and there's no clear answer at the moment. But one of the factors that central bankers often talk about is the long and variable lags in monetary policy and how long it takes to work through the system. And that scenario says that it takes between 12 and 24 months for an interest rate hike to be fully felt through the economy. Now, remember, the first rate hike we got in Australia was only 11 months ago. It was back in May. So the potential full effect of that first rate hike hasn't even worked through, and of course there was 10 in total. So it's a very good question why we haven't seen a major impact in the Australian economy. The simple answer is that there was a well-established savings buffer. Savings had skyrocketed during the pandemic, and that the households have been able to maintain current spending habits by using those savings made in the pandemic. There's still relatively a lot of savings out there, but the composition savings is the big question. A lot of the households that are well off and aren't paying mortgages have plenty of savings. It doesn't really matter to them. A lot of households that are relatively closer to the edge and really feeling the impact of higher interest rates don't have savings. So the composition of savings is going to be interesting as well. But the real factor is going to be these long and variable lags in monetary policy. That doesn't go for Australia as well. I think that's going to be why the next couple of months is going to be particularly interesting. And Boris mentioned at the start that we'll be watching data really closely to see how it plays out. There still remains the capacity that we just haven't felt the full impact yet. And if we start to see that come through, if we see a shutdown in spending, if we see a real shift in consumer behaviour, then that can certainly impact the real economy. But what's going to be most interesting is how it impacts on financial markets. The NASDAQ, for example, the US technology index is up 20% since the start of the year, again 20% in the first quarter of 2023. For a big rally like that, it is vulnerable to fall. So if we do start to see an impact on the consumer behaviour as a result of these rate hikes, even if it is lagged, then financial markets do have the capacity to sell off, and that's going to be negative for the Australian dollar. I think that's about it for questions. So I'll give everyone one last minute to ask anything, but thank you for your input today. The recording for this will be available over the next 24 hours and sent to attendees via email. I mentioned earlier the Convera website. You can go there and get access to our market reports, our previous webinars, and some of our most up-to-date daily research notes. So please, if you need more information, you can go to the website, or as I said, speak to your relationship manager. They'll be able to help you. I'd like to say a massive thank you to Rob for joining us, for Boris for joining us from Europe. It's very early over there. He's our global expert on what's happening in the macro world and the banking system in particular. So we're really grateful for him to have provided that insight to us. Remember that the monthly FX Outlook webinars come out every month, the first few days of each month, and hope to see you all again at the May webinar when we present it. Thanks again, and all the best. Bye-bye.